Rivian, the electric vehicle maker that went public last month, reported its third-quarter earnings on November 9, 2022. The company beat expectations with a narrower-than-expected loss and reaffirmed its production target of 50,000 vehicles for 2023. Here are some of the key highlights from Rivian's earnings report. Rivian's revenue was $536 million, which fell short of the Wall Street consensus estimate of $551.6 million. This result was up from $1 million in the year-ago period and 47% higher than in the second quarter of this year. Revenue was primarily generated from vehicles delivered in the quarter. Rivian's adjusted loss per share was $1.57, versus an expected loss of $1.82 per share. The company's net loss widened to $1.3 billion, compared to $897 million in the previous quarter and $233 million in the third quarter of 2021. The increased loss was mainly due to higher operating expenses related to ramping up production, expanding facilities, hiring talent and developing new products. Rivian delivered 9,317 vehicles in the third quarter, including 8,614 R1T pickup trucks and 703 R1S SUVs. The company also produced 2,000 electric delivery vans for Amazon, its largest customer and investor. Rivian said it expects to deliver 25,000 vehicles in 2022 and 50,000 vehicles in 2023. Rivian ended the quarter with $7.7 billion in cash and cash equivalents, which it said provides sufficient liquidity to fund its growth plans. The company raised $11.9 billion from its initial public offering in November, which valued it at $86.7 billion. Rivian is now the second most valuable automaker in the US after Tesla. Rivian also shared some updates on its product pipeline and expansion strategy. The company said it plans to launch 2 new vehicles in 2023, a smaller SUV called R2X and a rally-inspired sedan called R1L. Rivian also said it is exploring opportunities to enter new markets such as Europe and China, and to build additional manufacturing facilities. Rivian's earnings report showed that the company is making progress in producing and delivering its electric vehicles, despite facing supply chain challenges and rising competition. The company also demonstrated its ambition to grow its product portfolio and global footprint, while maintaining its commitment to sustainability and innovation. Rivian stock rose more than 10% after hours following the earnings release. In this section, we will talk about how Airbnb disappointed investors with a weak outlook for bookings in the second quarter and warned of tough year-over-year comparisons. Airbnb is one of the leading online platforms for booking and hosting travel experiences. The company has been benefiting from the recovery of travel demand amid the pandemic, as more people seek alternative accommodations and local trips. However, Airbnb's latest earnings report showed some signs of slowing growth and rising challenges. On Tuesday, May 9, Airbnb reported its first quarter results, which beat analyst estimates on both revenue and earnings. The company posted revenue of $1.8 billion, up 20.5% year-over-year, and earnings per share of 18 cents, compared to a loss of 3 cents a year ago. The company also announced a new $2.5 billion stock buyback program. However, investors were not impressed by Airbnb's guidance for the second quarter, which was slightly below expectations. The company expects revenue of $2.35 billion to $2.45 billion, versus consensus of $2.42 billion. The company also expects adjusted EBITDA to be similar on a nominal basis from a year ago, but lower on a margin basis. The main reason for the cautious outlook is that Airbnb faces tough comparisons with the second quarter of last year, when it saw a surge in bookings due to the Omicron variant of COVID-19. The company said that it expects fewer bookings and lower average daily rates in the current quarter versus a year earlier. Additionally, Airbnb is facing some headwinds from rising costs and competition. The company said that it is investing more in marketing, product development, and customer service to attract more hosts and guests to its platform. The company also said that it is lowering its prices to stimulate demand, especially in North America, where it has the most price-sensitive customers. Airbnb's stock price fell 11% in after-hours trading following the earnings release, and continued to slide on Wednesday. The stock is now trading at around $111 per share, down from its 52-week high of $144.63. Analysts have mixed views on Airbnb's prospects. Some remain bullish on the company's long-term growth potential and competitive advantage in the travel industry. Others are more cautious about the company's valuation and near-term challenges. In summary, Airbnb disappointed investors with a weak outlook for bookings in the second quarter and warned of tough year-over-year comparisons. The company faces some headwinds from rising costs, lower prices, and increased competition. However, the company also has some strengths, such as its loyal customer base, its diversified offerings, and its ability to adapt to changing travel trends. In this section, we will look at how Twilio slid on a revenue forecast that came in below analysts' estimates and cited shrinking demand for cloud services. Twilio is a cloud communications platform that provides software tools for developers to build and operate voice, video, messaging, and chat applications. Twilio has been one of the beneficiaries of the pandemic, as more businesses shifted to online communication and collaboration amid lockdowns and social distancing measures. However, Twilio's growth has slowed down in recent quarters, as customers have become more cautious about their cloud spending and have optimized their usage of Twilio's services. Twilio also faced some headwinds from currency fluctuations and regulatory changes in some markets. On May 9, 2023, Twilio reported its first quarter results for the fiscal year 2023. The company posted a 15% year-over-year increase in revenue to $1.01 billion, slightly beating the consensus estimate of $1 billion. The company also reported an adjusted net income of 47 cents per share, surpassing the analyst's expectation of 21 cents per share. However, Twilio's guidance for the second quarter disappointed the market. The company forecasted revenue in the range of $980 million to $990 million, which was below the average analyst estimate of $1.05 billion. The company also projected an adjusted net loss per share of 2 cents to 4 cents, while analysts were expecting a profit of 23 cents per share. Twilio attributed its weak outlook to several factors, including lower demand for cloud services from some of its customers, especially in the travel and hospitality sectors, which were hit hard by the pandemic. The company also cited some challenges in its international markets, such as regulatory changes in India and China, and currency headwinds from a stronger US dollar. The market reacted negatively to Twilio's forecast, sending its shares down nearly 13% in after-hours trading on May 9. The stock continued to slide the next day, closing at $204.56 per share on May 10, down 14.7% from its previous close of $239.82 per share. Twilio's stock performance contrasted with some of its peers in the cloud space, such as Airbnb and Rivian, which reported strong results and outlooks for their respective businesses. Twilio's stock also lagged behind the broader market indices, such as the S&P 500 and the Nasdaq Composite, which both gained about 1% on May 10. Twilio's revenue forecast raised some concerns about the sustainability of its growth and its competitive position in the cloud communications market. Some analysts questioned whether Twilio's customers were switching to cheaper or alternative solutions, or whether Twilio was facing increased competition from other players, such as Amazon Web Services, AWS, Microsoft Azure, or Google Cloud Platform. Twilio's management tried to reassure investors that its long-term growth prospects remained intact, and that its revenue guidance was conservative and reflected some temporary factors that would not affect its future performance. The company also highlighted its strong customer retention rate, its diversified revenue mix across different segments and geographies, and its continued investments in innovation and expansion. Twilio's CEO Jeff Lawson said on the earnings call that he was confident that Twilio would emerge stronger from the pandemic and would continue to lead the cloud communications market with its differentiated platform and products.